Hey everyone, Sirius XM Holdings has been an underwhelming stock over the last several years and last several decades, to be sure. But the stock price decline could be a buying opportunity for investors if it's cheap enough. So in this video, I'm going to look at its prospects, its last several years and how it's performed and the profit margin and the cash flow, and weigh it against the valuation and determine if this stock is a good buy for long-term investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I mentioned that Sirius XM stock has been underwhelming. You can see a stock price chart here going back 5 years. The stock is down from where it started at around $6 down to $4.80 when we look at a 5-year time period. If I zoom out for a 10-year time period, the stock price has performed better, up from about $3.25 to $4.80 for a roughly 50% increase in the last 10 years. Still, that investment would have trailed the S&P 500, which gained more during that time. Overall, Sirius XM Holdings has not been a good investment for investors over the last 5, 10, and 20-year time horizons. Why is that the case? Well, it's losing market share, it's losing revenue growth, and it's gotten behind in the competition for people's attention when they're in their cars, especially. Now, it does own Pandora Radio, which is the streaming music provider. However, that has failed to keep the company afloat in this industry. You can see here revenue has been flat, 8.95 billion in the last year and a half. It's been relatively flat. If you go back longer term, it's increased from about 4 billion in revenue up to 8.95 billion in revenue. However, that's come at the expense of margins. If you look at its operating profit margin over a trailing 12-month period, you can see that's down to 22.64%, which is still a really good operating profit margin, but it's down from around 27% where it started the previous decade. Now, if you see the revenue has increased, revenue has more than doubled, but the operating profit margin has decreased. That's not what I like to see. Usually I like to see the opposite. When revenue is increasing, I want to see profitability rising. You're not seeing that with SiriusXM. You're seeing operating profitability declining as revenue is increasing. That's not very good news. That's not a very good sign. And that's demonstrating diseconomies in scale here. It's the opposite of economies in scale. Now, I want you to understand the importance of the cash flow from operations metric. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you understand the importance of this figure, you can see why this is troubling. It's going downward in the wrong direction. 20.66% is the lowest this metric has been for Sirius XM in the last decade. Does not seem to be improving, and I'm going to show you their prospects over the next 2 or 3 years, and it doesn't look like it's showing much progress either. So let me show you over the next few years, 24, 25, and 26 fiscal years. Revenue expected to decline 1.7% in fiscal year 2024. Sirius XM management also said that they expect revenue to decline. These forecasts are from Wall Street analysts that are following Sirius XM stock. They expect 1.7% decrease in revenue, 6.6% decrease in earnings per share. 2025 is expected to be a better year with 5% revenue growth and 9.6% earnings growth, but then another decline in 2026 of 0.3%, but earnings per share growth of 7%. So volatile earnings per share and revenue growth expectations over the next few years for Sirius XM. And given that fewer and fewer people are subscribing to Sirius satellite radio, usually this happens when people purchase a new car. Some cars come with a free 3-month trial or 1-month trial to Sirius XM radio, and they hope that people upgrade to the paid version once that trial period is over. However, that strategy has not worked well for Sirius in the last couple of years. They continue losing subscribers and they're not gaining traction as desired. Competition is plenty, with Apple, of course, launching its own, music service and podcast. That's very popular with consumers. That's getting a lot of attention. And Spotify is getting a lot of attention as well. Between those two, they're taking significant market share. And that's leaving Sirius XM behind in the race for people's attention. And the valuation is not incredibly cheap. Sirius XM is trading at a forward price to earnings of 13.91, which is not incredibly cheap. I would like to see a much cheaper valuation for a company with these kinds of prospects facing this kind of competition. I would like to see a lower valuation in the single digits if I was to recommend this stock. So overall, I would not recommend Sirius XM stock as a buy. I would place it in the category of a hold and wait for a price decline or more demonstration of increasing market share, increasing subscriber growth to convince me that the stock is viable for long-term investors to buy. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.